area in building this is through innovations. And we shared with you that we had kind of rolled out the veg puff in the past, and now we're sharing with you we are the first brand in India to have launched the chicken puff as well in India. So that, including all other innovations, including the cafe and so forth, we have continued to drive traffic into our restaurants through these initiatives. Second, big bucket for us is the digital first brand, as I've outlined last time. And today, again, starting only about 18 months ago when we had no self-ordering kiosk, all the orders were taken on pause. And between this last 18 months, we have taken this portfolio of 510 restaurants to 437 restaurants with SOKs, self-ordering kiosks. 90% of our sales that comes into our restaurants, 90%, I repeat that, is digital. It's either through our kiosk, where the customers place it, or it's through our table ordering, where there's QR codes on the table, or it's our app, which allows you to order not only delivery but also dine-in. And we are doing a big push through building our business through the dine-in app as well. So again, 90% of those orders are digital. 437 restaurants have SOKs or self-ordering kiosks, and they also have table ordering and so forth, and the digital journey. Now we're going to move the balance in this next quarter. We will reach and have close to 100% of our restaurants with this King's journey, which we call the digital journey, which means SOKs and so forth. So that's one big initiative that we are focusing on. Now the app is another one that we are continuing to grow on our downloads year over year. It's about 30% growth on the downloads of our digital app, and Kapil will kind of dig into a little deeper on how we are using that in building our business over there. The next pillar is for us is profitability, right? We told you that we are wholly focused on the restaurant profitability, but also laser focused on making sure that our delivery business we improve our profitability on the digital business. So as we look at Q3, the delivery profitability has gone up by 70 bits, and we continue to push that in the north direction. If I go from this to the KPI results for India for Q3FY25, as I said, we reached 510 stores. That's 46 stores over last quarter, which means we built 46 stores in this quarter, 69 stores year over year. 494 crores in revenues, which is 0.7% quarter over quarter and 11.2% year over year. Our average ADS or average daily sales was 114. Now our SSSG was only negative 0.5, basically flat SSSG, and which means that the ADS of all these stores that were comping over last year was basically what it was, and then the new stores, which is roughly 90 stores that were not comping, they have brought down the ADS roughly by about 5,000. But those are new stores, and like we always say, the new stores usually reach the average ADS in 2 years. So that we are hoping to catch up. Gross margin 67.8, improvement there 0.3 quarter over quarter and 0.7 year over year. Restaurant EBITDA is a good part of in spite of having a lower ADS and literally flat sales in terms of SSSG. As a company, we delivered 59.6 million, which is about 596 million, which is 59 crores in restaurant level EBITDA. This is pre-Ind AS numbers that I'm giving you. 14.5% quarter over quarter and 9.7% year over year. So that's a well done job with tighter sales delivering a higher profit. And then finally, company level EBITDA, again a very good story here. We have delivered 30.9 crores in total company EBITDA. Again, an improvement. 26.7% improvement quarter over quarter and 2% year over year. Steady performance, again, in line with our goals, which is to make our business more and more profitable each day. We continue, and most of this profits, we'll share with you, and when Sumit is speaking, is driven by many initiatives that we have shared with you in the past, whether it is utilities, whether it is gross margin, whether it is, rents at the restaurant and so forth. So all these initiatives, including some prizes that we take from time to time, have grown our profitability in that direction. Now, just coming to Indonesia. Indonesia, we have spoken extensively about. I just want to kind of update people that may not know. Of course, the war in Gaza or the shooting has been put on hold. There's a halt on the war over there. Some good sentiments of that is flying into Indonesia, with the U.S. being involved in bringing that, ceasefire in effect. And we are seeing an increase in traffic in our restaurants, which is a good thing because people initially didn't want to be seen in our restaurants or in any of the U.S. brands in Indonesia. So that's a good thing that people are now coming in, and we see a positive, traffic in our restaurants. The last couple of months have been very good. January has been a good month in terms of a recovery in Indonesia in terms of traffic into the restaurants. However, we have closed stores there in the past, and we have shared those with you in the last meeting. We continue to run 147 stores, which is 15 stores less year over year. That we run on the Popeyes front. We run 25 stores. We are not building any stores there for the next couple of years, as we have told you in the past as well. Revenues were at, this is again IDR, and Sumit will share with you any INR numbers, but 269 billion, which is still negative 9.6 year over year. And then we go to average daily sales, which is at 17.6 million. SSSG, which was deeply red last quarter, has come down to only negative 4.1%. So we see that kind of positive drift of people coming back into the business. Popeye's average, ADS or average daily sales was at 14 million. This is a definite area of focus, and Kapil will touch on what we are doing in terms of both Burger King and Popeyes in Indonesia, and we'll get you on speed on that. There was a 39.5 billion in terms of a company EBITDA loss. This is again pre-India's number, IDR. And I'll just give you our strategy again over there. It's very simple. We want to continue to now strengthen and bring back our restaurants, dine-in business, and there are multiple strategies. Value has been instilled. The products, as I've told you in the past, now we have the full range of chicken products over there. We have rationalized the restaurants, so we have closed those restaurants with very low volumes as well as high losses. So we can optimize that piece in there for our portfolio. We continue to work diligently with landlords in terms of reducing rents, and that work will continue through the next year as well to make sure that those restaurants which are in the brinks of becoming positive, that they start becoming in terms of restaurant level EBITDA will turn positive. And then we brought down corporate overheads as when we took over this business. It was at about 65 crores. We have brought it down to around 45, 46 crores, and we are working further to bring it down. And in the next quarter, we will make some significant gains on that as well. So all fronts, fix the product line, fix the infrastructure, which is the restaurants, getting in dine-in with new marketing. And again, Kapil will talk to you about what we are doing in terms of marketing over there. And then reducing corporate overheads as we kind of shrunk down the portfolio to about 147 restaurants. So that's basically the strategy. Good vibes over there. The new government over there has said that they will aim to at 8% kind of growth versus 5% initially that they were sitting on. There's a lot of pro-India, Indonesia conversations. 5 MOUs have been signed between the two countries. And I think there's going to be some good, leverage we can use from our distribution system here in India moving forward into Indonesia. So those are the key highlights for Indonesia and India. And then with that, I will turn it over to Sumit Zaveri, who will walk you through the numbers on both of them.
Thank you, Raj. So I'll just quickly take you through the India and Indonesia performance on the financial side. I'm on slide 10. We ended, as Raj mentioned, we ended the quarter with 510 restaurants, added 69 restaurants. Parallel to as we were adding stores, we also kind of continued to increase our footprint on the cafe side. We are currently having 433 restaurants having cafe. Large part of that, or literally the entire growth at the moment on cafe side, is on account of new store additions that we've done. The gap of close to around 80 restaurants that we have, we will continue to evaluate, and as we feel as the opportunity is right, we will add cafe in the balance part of the portfolio as well. Digital has been our focus this year. We want to take the journey forward to make sure that we understand and know our customers better. This year we made the investments on the digital side. Currently, we've covered around 437 restaurants, where we've completed our digital investments. There, we will over next quarter or so, you will see that number would have ramped up to the entire part of the portfolio. And we are working on this because we want to, on the layer of this, we want to now go to the next layer of CRM and loyalty once we've completed this cycle of our investment. So that's literally how we expect this part of the journey to go forward. As far as ADS is concerned, yes, our SSG for the quarter has been flat. Our ADS stands at 114,000, largely slightly lower than what we've seen in the previous quarter or the same year last time. Is more because of the new stores that we've opened. But at the same time, we made sure that while the ADS might have come down, we kind of make sure that we bring efficiencies at the store level on the P&L. And as you can see in the bottom part of the chart, consistently we've been growing our store level EBITDA from 7.8% to 12%, and trying to kind of make sure that it remains in a reasonably good range, while the ADS remains in a very tight margin. So that's something which we've been working hard on. As far as company EBITDA, it is really reflecting the trend on restaurant EBITDA. We've been growing it back up to 6% over last 4 quarters, as you can see from 2.4. Very clearly, we moved back to 6.2% with ADS at 114. So we feel very strongly about our journey on restaurant and company EBITDA side. We've been talking about gross margins. You can see that we moved from 67.1 to 67.8. We continue to remain positive on that part of our journey, and the trend that we've been talking about in the past, we will kind of continue to take steps over to get to that, our goal on the gross margin side. Going on to overall performance, while I've already spoken about the larger part of the overall India performance part, just to kind of reflect one line which I would like to kind of highlight, that we've been focusing parallelly on the G&A side. You would realize that we've kind of now maintaining the G&A on a total basis of around 27 to 28 crores. We would remain tight on this going forward as well, and see how we can kind of bring some more efficiencies as percentage to revenue going forward as well. So with that, I'll quickly run on to the Indonesia part of the performance. Indonesia part, the growth, the revenue stands at 143. This is a revenue combined for both the brands put together. A drop of 9.5%, but that's predominantly because of the store closure decisions that we've taken over last year to make sure that the numbers could kind of start looking better. Last year, on account of where the market was, we had taken, in order to kind of drive sales through delivery, we had to take certain actions on which dropped our margins. We've moved back from 55.8, as you can see, to 57.8. Some part is correction that we've done on the delivery side of the pricing, and then certain other initiatives as dine-in part of the business comes back. So we feel positive that we've at least been able to come back to 57.8 and then work towards how do we take this forward. As you can and then as we make the recovery in Indonesia, you would see some amount of marketing investments to happen from our side to revive or bring sales back. As Raj was saying, we have seen early shoots of dine-in sales improving, and which is also reflected in our occupancy other expenses line. The increase over quarter on quarter or over last year is largely represented by the marketing investment that we made in Indonesia to just start recovering sales back. We might see some part of the trend also into next year as we want to continue to recover dine-in sales. Parallelly, while we are working on improving the sales, we do understand that we need to be really tight with our corporate G&A. We've continued that journey in improving the overall corporate G&A number in Indonesia. For the quarter, as you can see now, we stand at 10 crores for the quarter from the 15 crore that we had last year, same quarter. So we are definitely moving on this side, and we would work further down to see how we can further optimize these costs. And that part of the journey will continue. But we are strongly focused on how do we get the overall Indonesia performance to where we want it to be. I would not get into the consolidated performance having gone into India and Indonesia, and rather turn the page to Kapil, who can take us through the marketing initiatives for India and Indonesia.
Thanks. Thank you, Sumit, and good evening to everyone. I'll start by talking about the India business. India, our strategy has been very clear and consistent. Number one pillar, value. In any retail business, more so food retail, the lifeline of the business is footfall in the stores. And we continue to focus on that. There are three parts to our value strategy. There's a 2 for 79.99, which is a price point strategy for driving new footfall in. We've got 2 crispy veg at 79, 2 crispy veg, 2 crispy chicken at 99. And we've seen very good traffic growth for the whole year, and including the last quarter in dine-in on the back of this program. Now we have a new layer, which is the app deals. So consumers who use the BK app get exclusive coupons. That's another way of delivering value to the consumer. And the third, component of value is shareable meals, which we launch these thematic meals every season from New Year's to Valentine's to Diwali. And these are shareable meals with 2 burgers at a good value for the consumer for these occasions. So all these three dimensions of value help us grow traffic in dine-in. As I mentioned, we had a strong quarter on dine-in traffic and sales growth. In dine-in, now what we have done, as consumers come into the stores, we have strengthened our snacking portfolio. We started the year by launching the veg pizza puff, which gave us phenomenal results in many markets in the country. Then we added the chicken pizza puff, which is a first in the QSR, and it's also giving us very good response from the consumers. So with these products, if you look at our snacking portfolio, which is the largest day part and the most important category, one of the most important categories in any QSR business, because consumers add it on to their main items and use it for multiple occasions. We have a fairly strong menu now. With the puffs, with the fries, loaded fries, high fries, veg strips, boneless chicken wings, fried and grilled wings, and nuggets. And all of these products, build the portfolio. In addition to that, cafe, an important layer in our business. Our focus has been on driving awareness. Now we have 433 cafe distribution points, so to say, on the ground in stores. The focus remains on driving awareness. And we've been doing a lot of interesting social media engagement programs to make sure we connect with the Gen Z and the millennials to make sure they're aware that there is coffee available at Burger King and very good quality coffee available. To give you one example, we did an activation on Roast the Roast. Right? So you've had coffee in multiple places as consumers, as fans. Tell us about your poor or good coffee experiences. We will talk about it. We'll make sure that we give you a great cup of coffee at BK Cafe, with the 100% Arabica beans for free to come and try our product, right? And multiple other such programs. The recent one was the fortune teller, which gave us about 6,000 participations, which is quite fantastic on a social media contest. Also in dine-in, now on slide number 18, we continue to drive digital transformation. Raj spoke about it, Sumit spoke about it. As we get more and more customers in the store, the experience in the store is getting elevated by leaps and bounds. So there is a 100% digital experience in the store. A customer can come in and order on the self-ordering kiosk, can use the QR code to skip the queue. Their food will be served on the table, so there is a full 360-degree experience improvement in the store. And now about 90% of our dine-in orders are coming through these digital channels. So that tells you that the consumers are really appreciating this new store experience and are coming back more often and liking the experience they're getting at a Burger King store. A component of this digital experience is the BK app. Now that is very important to lay the foundation of the CRM program for the future. What we're doing here is that we're offering exclusive deals to customers who log in on the BK app. We've seen cumulative installs grow to 13 million, which is almost 30% growth year on year. A lot of this has happened through organic visibility at store, through a lot of merchandising at the store. We've driven app exclusive deals and seen a user base grow by 2.3x and also orders grow by 3.3x. So very good sort of growth. We are in the acquisition phase right now. As we reach this sort of phase where we have acquired enough users on the app, we will start doing the next phase of engagement and frequency. While we build these experiences in the store, we make sure we connected with the users, our fans, our Gen Z, in very exciting content pieces on social media. Just to give you an example, on Diwali, given the fact that Burger King stands for taste and taste is king at Burger King, we use that insight to build a concept called the Swad Ka Pataka on Diwali. We use very interesting, Diwali patakas packaging, very engaging content. Consumers could use, artificial intelligence to create their own packaging, put their name, and had a lot of fun with that. And we got amazing participation on this contest. That was India. Now we'll switch to Indonesia. In Indonesia, again going back to our strategic pillars, very well thought through and consistent. We are building a strong menu. Chicken is a big part of the menu there. We've got 3 variants of chicken there now: classic, spicy, and dunked. Spicy was a miss in our menu. We launched that last year, and last quarter we promoted that on media as well. Burgers have been renovated. Whopper is now a much better tasting burger as per the Indonesian palate. We've continued to launch LTOs and desserts, which is a popular category in that market. We continue to work with Milo and Nestle to launch these products there. And we have also a strong value proposition at 17K, which we've been promoted through coupons, through social, digital, meta, and multiple other platforms. What's very heartening to see that there is some light at the end of the tunnel, given the geopolitical challenges we've had in the market. In the recent times, we've seen some reversal of those headwinds. We see, if you focus on the numbers on slide number 23, November and December, we started to see our ADS grow. Yes, we are lapping over a weak period of the last year, but it's good to see that, especially in dine-in, consumers are now willing to come back to the restaurant, come back to a Western QSR, right? So some bit of that inhibition is going away, which is a very good sign. Not just for us, we're also seeing the industry improve across, which is a good sign overall for market in that country. If you go to slide number 24, our SSSG in dine-in has become positive now. Again, I would temper that. Yes, this is over low periods, but it's good to see that consumers are willing to come back, right? So that shows us, some green shoots in the future. Now, this has been on the back of the chicken campaign. We were on media in November. We continue to stay committed to the business. That's why we made the investment in media, in marketing, and promoted a core menu item, which is spicy chicken. People love that product there. We saw some good returns on that. And we continue to innovate on slide number 25 with, Whopper variants, with mushroom steak, with desserts, with coffee, to make sure the consumers, we stay relevant to the consumers in that market. On the last slide, just to tell you, as I said, we are seeing some improvement in trend. We've always seen that improvement whenever we've had, a consistent marketing effort. Unfortunately, there have been events that have held us back, but we see that trend coming back and returning, right? Now, I would hand over to Gaurav to close the presentation.
Thanks, Kapil. So on the outlook, we have already achieved our target of opening 510 stores this year. We are currently in the process of finalizing our annual operating plan for next year. Once we do that, we will come back to you in the Q4 update with the outlook for FY26 and beyond. So thank you everyone for joining in. I would request the moderator to please open out the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue first question is from the line of Avi from Macquarie. Please go ahead.
Yeah, hi everyone. Thanks a lot for the opportunity. My first question is, if you could just share your thoughts on the near-term demand trends in India, and how do you see the same-store sales growth path for us behaving?
Yeah. So look, forward, if you look, we look at backwards first. Our demand in the restaurant continues to be strong, right? We continue to report and share with you that our dine-in traffic continues to improve, right? So we don't see that this trend that we are having in our dine-in restaurants, our dine-in sales, is going to reverse in any fashion, right? So only improvements are going to come on top of this. We have taken a strategic decision to optimize our profitability on delivery. So while, we have worked very hard to drive more people into our restaurants, which we have done very successfully in the last several months, we have also, on the other hand, optimized the total traffic coming into delivery and increased the profitability of our delivery business. You will see that fully come. We've seen 70 basis points this last. You're going to start seeing the full effect of it when you have the full quarter with all the things in effect that Kapil has put in. So you will, as a company, we are focusing on dine-in traffic, and that continues to grow, and we think that it's going to continue the way we are seeing in our restaurants in the last few quarters. And on the delivery front, we will continue to optimize and make sure that we are doing profitable business over there, making more and more money versus having more traffic there. So these are two strategic pillars of ours. We kind of continue to stay true to that, and I'm pretty strong about both these pillars, and I think our traffic and our dine-in will continue the way it has been in the last 2-3 months.
No, so where I was coming from is, if I look at the 3Q performance, there clearly is an improvement in the same-store sales growth trajectory, and that's, congratulations to you guys. I was trying to kind of see if you were to parse it on a monthly basis, or if you look at what has happened till date, does that give you any confidence on this further rising or improving beyond the initiatives? Because there is a macro environment which is concerning, and that is where this question was stemming from.
Yeah. Well, look here, without making any forward-looking statements, it's pretty clear that, the industries, you will see the numbers come in. There's a couple of companies already, 3 companies have released their numbers, all show that the negativity is kind of vanishing and the positive sales is coming. So I think you should just kind of, project from there, like we are all doing. And, like I said, we have seen positive sales in our dine-in business, and we continue to see that. We don't see that changing any differently.
Perfect. Got it, sir. And so secondly, as we explore the path to raise additional growth capital, would you also share your thoughts on how should we look at capital allocation between India and Indonesia?
Yeah, so Indonesia, we have already said this in the last quarter, and I'll kind of repeat this over here. Our intention is not to build any restaurants there over the next couple of years. Our intention is to make that business profitable. So capital allocation over there is strictly going to be, and what Sumit was saying earlier, only to drive sales into the restaurant, which means we will only be looking at strategically spending money in marketing area to drive more, and that we will test that through before we kind of spend any capital in trying to bring more and more marketing sales. But there will be some strategic spending above and beyond the 5% we spend in Indonesia on marketing next year, and that's predominantly will be based on thorough analysis of where the market is and the right time to do that spending. But apart from that, there will be no capex allocation to building new restaurants, as we are not going to build any Burger Kings this coming year, and we're not going to build any Popeyes this coming year. Instead, on the opposite end, we are going to continue to drive a reduction in our G&A, overheads, administrative expenses. We have told in the past that we have, reduced our support center, our head office over there to half its size. We have done a significant reduction on our G&A in terms of, both people side as well as other expenses that we do. And the final piece over there is we are also working on rent reduction all around from all the restaurants, and we're making some good initial successes over there. But predominantly, you will see Indonesia turn around only when the entire market over there has positivity in terms of same-store sales. And we have seen 2 months of dine-in positive sales, but we want to stay optimistic, but also stay kind of very true to it. So hang in there and wait and watch us kind of turn that business around.
Okay, sir. Okay. I mean, where I was coming from, so if I hear you correctly, primarily loss funding that would be required. And I was just trying to get a sense on how much do we have, do you think the pain is there? That's what I was trying to gain. I know part of it may require a forward-looking understanding, but just an appreciation of, how do you see the requirement is where I was coming from. But I got an answer. There is more loss funding that you would look for, and the expectation is that funding will go down. That's a fair way to summarize it, right?
Yeah, look, see, I gave you both the numbers, right? I told you the top line is improving in dine-in restaurants, and hopefully we'll catch on the rest of the business. And I also told you that we have cut down our, overhead G&A to, from 65 crores when we took over the business down to 40 crores, and then we are working on further reducing it. So all our losses on the administrative side, which is sitting at, is going to be cut by that much, 40% of whatever that number is, right? So that in addition to increasing our ADS, you should be able to kind of project that. We don't want to, and on this meeting kind of tell you how much we're going to allocate or hold. We are going to be very, very judicious with what we put in there. One, because of timing. We want to make sure we don't put money before the right occasion. And second is to be prudent about how much we put in and which channel we put in. But predominantly, whatever we spend there will be to cover the losses or to invest in marketing and build the sales over there. That's predominantly what we're looking in terms of spending there. Is that fair?
Yeah, that's fair. Thank you. Thanks a lot, sir. That's all from myself. Thank you.
Thank you. The next question is from the line of Aditya Soman from CLSA. Please go ahead.
Hi, good evening. Actually, just one question on Indonesia from me. So, would it be fair to say at this point that Indonesia from here is sort of looking at the up? I mean, the worst is behind from sort of a demand environment perspective. The whole geopolitical situation as well seems to be at least on the mend. So from here on, at least with no further store ads in the region, we should start seeing an inflection in same-store sales growth.
Yeah, three things, right? First is the geopolitical environment seems to be kind of, going in the right direction, right? The war has stopped. There's some good conversations about U.S. helping that happen. There's a little, reduction in anti-U.S. kind of feelings, and I think it'll take a little while. It won't happen overnight, but we're seeing some positive, movements in that in the market. So that's one big piece, right? The second is we have optimized the store, but we haven't stopped optimizing. We will continue to look at stores where rent reduction is not possible, and where the landlord is not willing to do it, or if the rent reduction given to us is not enough, we will continue to optimize the store. We are not going to continue to sit there and wait for all the sales to come in. We will get there together. While the market is improving, we are also working towards getting that to a positive, cash flow over there. At least break even very quickly. So that's the second bucket. The third bucket really is, there is no need to be building restaurants here because we have kind of sat down and done an agreement with our franchisor in terms of this, and we are not going to be building. And it's the right thing, right? You don't want to continue building restaurants where you're trying to turn around existing restaurants. So there's no requirement for us to do that. There's no pressure on us to do that. So we will not be doing that.
That is very clear. Thank you.
Thank you.
The next question is from the line of Jai Doshi from Kotak. Please go ahead.
Hi, thanks for the opportunity. One is, what measures have you taken to improve delivery business profitability in India? And is it essentially reducing discounting, or have you managed to negotiate better commission or take rates with the aggregators?
Both. So, yeah, that's the simple answer, but, there's a lot of stuff that Kapil is doing. One is, he's optimizing the menu that he's put on the delivery, right? So, that there is a differential pricing on that menu, and there are different deals on different days. So he's optimized that. So that's step number one. Yes, we have taken some pricing there, including the product mix over there. There's other stuff that we have done in terms of what we are selling and what are the packaging charges, et cetera. But more predominantly, beyond all this effort of optimizing these, we have also gone and negotiated and brought down some of our commissions, and we will continue doing that because this is something that we don't stop doing. This is the area where we want to make sure we are efficient in this P&L. And we have made some very significant gains in a matter of 2 quarters since we started doing this. And we are not going to stop. We're going to continue making our delivery business more and more profitable. And we will not stop until we get it to a double-digit number.
Sure. So what is the differential as of now after these improvements, differential between delivery business margins and dining business margins for the India business?
Yeah, we don't share that level of P&L because of competitive reasons. And so I just respectfully say that if you have any, micro questions on this, that you just reach out to Gaurav. But we don't generally share those numbers.
Understood, fair point. Now in India, what is the ADS you need to get to reach 10% company level pre-Ind AS EBITDA margins? You're at 6%, 6.2% this quarter. It's a seasonally strong quarter, so maybe on a normalized basis you are somewhere around 5-ish. So for you to move from 5 to 10, where should your ADS settle from 114,000 that you did this quarter?
Yeah, so it's not just ADS, right? If you know that our overheads are pretty much kind of, where they are, right? Sumit was saying we are further going to optimize our G&A even in India, not just in Indonesia, even in India. We continue to be a company that continues doing that. It's just the DNA of our company that we look at costs every year as if we are looking at it for the first time and start reducing. So that journey is going to continue. Now, what happens with that is as you continue to build more and more restaurants and your G&A or your overheads are fixed, then that number below, which is the company EBITDA, continues to grow. So that's one of the levers that will continue growing that number from 5, 6, 7, 8% onwards, right? So that's one of the levers. The second lever is ADS, right? As you improve your restaurant level EBITDA, of course, that will contribute more towards covering your overheads and going into the company level G&A. So both these levers are there, and they will both help and we're making some very good strides. There was only a time that we were negative company level EBITDA, and then we became positive at 1 or 2%, and then 3%, and then 4%. So we continue to climb. And this is nothing different than what I've been saying for the last 4 years that I've been, 4.5 years that I've been on calls, that we will continue moving these numbers forward. We will continue moving gross margin to the right level, right? We can move gross margin very quickly today as there's so much gap or headroom in pricing that Kapil has. We can do that, but we are building traffic at the same time we are doing this. So we want to make sure that we are prudent, we are doing this optimally, and that we are at the same time improving traffic, minimizing any loss due to higher pricing, and at the same time improving gross margin, improving our rent ratios. Utilities, Sumit was talking about that earlier when he was talking in the P&L. We have made some very good strides on utilities. We have reduced utilities. The rates have gone up, but the unit consumption, we have significantly reduced it by many simple things that we have done in the restaurant through engineering. We have a very good engineering team that has launched a complete program end-to-end for all the restaurants. So we have gone through a few restaurants, probably 20-30%. We will finish all the restaurants by the end of next year with all these modifications that we are doing, which will continue to bring the utilities down as well. So all these put together is going to bring us to that level. It's just not the ADS.
Sure. And one more on Indonesia. So, I heard your previous response. It looks like at this point of time, on one side, you are trying to renegotiate rentals and cut down G&A. And wherever it is not possible or viable, you may optimize or rationalize the store network further. And I think, overall focus is to get to EBITDA break-even from 17.5 crore quarterly loss, let's say 50 crore annualized EBITDA loss. But my question is that if eventually, with a much smaller store count than where you are today, even if you reach EBITDA break-even, it still doesn't result in any value creation from a shareholder perspective. So have you thought about, whether there is a merit of continuing operations in that market, or is there an opportunity to divest, Indonesia business? Is that something that, you have a timeline that maybe a year down the line, if you don't achieve the milestone, the targets you have, may have for the geography, would you take a more, tough decision?
Yeah, it's not a tough decision. All decisions that make investors more money and makes our company more money are the right decisions, and they're easy decisions. They're not tough decisions for us. See, I'll tell you two things. First is we got two great brands in Indonesia, right? We have Popeyes brand, we have the Burger King brand, right? These brands, Burger King brand, when, in the good days, heydays, as you call them, was throwing about 14-15% restaurant level EBITDA, right? We have closed 26 restaurants, so we haven't significantly changed the portfolio that we bought. We have closed 26 restaurants which do not have an upside, and we're losing money, right? So that's what we have. We have just rationalized the portfolio. We are not shrinking it, we are rationalizing it, which means that, we will close restaurants that lose money or where we don't think the economics is right for us, right? So that's one thing. Now, what is the decision if we are not successful, or if another war breaks out, or if, things go south because of some other issue and the market is struggling or the economy over there is struggling? Yes, all options we will always keep on table. We will always discuss all options. What is the right thing for investors is the right thing for me. I'm one of the investors in this company, individual investor in this company. So I will continue to look at this as what is best for all investors in terms of, the long term, right? So that's no different whether, we turn this round or someone else turns this round. But I can assure you that this is a strong brand. I've been with this brand for many years. Today probably will be at least 25 years with this brand in so many countries. And I know that this brand continues to be a very strong brand wherever it is. And I know that if we do not have the stamina to turn this around, someone else will turn it around in the future and make money, right? So that's the reality. So we as a company will be prudent. We will allocate capital at the correct time. We will allocate the right capital in terms of our marketing, not in capex right now. If we see this turning around, we will push it and we'll turn around quickly, as we have done with everything that we do. You saw that we started cafes, we finished them in 18 months. You saw we start digital, we finished in 18 months, right? This one, we had already turned around the company. In fact, in October, beginning of October, we had already reached break even, and we were going in the right direction when the war broke out. So we are unfortunately sitting in a geopolitical kind of climate which is now kind of recovering. So we feel good about this. We feel good about the last couple of months. We feel good about January as we see it in Indonesia. But yes, we are not blind. We will stay true and close to the business, and we will make appropriate calls when we cross those bridges.
Sure. Just one small follow-up, bookkeeping. Has the parent Restaurant Brand International supported you in any way? Because, this issue is largely because of geopolitical reasons. So have they waived off or reduced your royalty fee? And if not, have you, asked for it? What's the thought process?
RBI has been a fantastic partner. They have been very supportive. They've, been behind us, and they've helped in every way, in any way, and we are very thankful for all their support. Thank you.
Sure. Thank you.
The next question is from the line of Tejas Shah from Avendus Spark. Please go ahead.
Hi, thanks for the opportunity. You sounded quite positive on dine-in recovery in India. While you may not want to speculate on the future, but just wanted to know your view. What would have driven this revival? Structural factors or just a low base effect? Because the macro for consumption is not as conducive as it appears from our optimism here.
Yeah, very nice question. See, it's we were on value. Kapil was on value more than a year ago, right? More than a year ago. In fact, 2 years now making. He was on 99, and he went to 2 for 79. This is a value offering. It's not a tactical. It's a strategy. It's one of our pillars. We will always be a value leader, right? Now, when you are offering a certain, when you look at the market and you say the market has shifted to the left, where more and more consumption is on the value side, if you can provide a profitable value proposition, which is profitable to you, but it is also a value proposition that market is, which is what the market requires at that point of time, then you will flourish and you will continue. At the headwinds when people were reporting negative sales and especially negative sales in dine-in, Kapil kept on reporting positive sales on dine-in, right? So I think in the long run, if you ask me, I think there is a very strong, market for people coming in and dining in our restaurants. There are a lot of things that people come into the restaurant for. It's not just because they're taking a lunch break or they're buying something and taking a break. There are celebrations, there are birthday parties, there are meetings, there are so many occasions where people actually get out and eat at the restaurants. You have mall restaurants. There's a very small delivery component, if there is any. It is entirely driven by people coming into malls, watching movies, shopping, and then eating. There are highway restaurants that are completely dependent on people going on the road, stopping at the highway, having a break and eating. So delivery is a small component of the high street business. It's not an entire business to many of the restaurants that we're building. So as you look moving forward, there's an immense amount of infrastructure that is coming along highways, whether it is in north or now predominantly in west and south. And you will find these highways coming on where we will be building restaurants that will be on the highways. These will be predominantly, dine-in restaurants, right? There's no delivery on a highway restaurant. So you will find that this is going to improve more and more, and that's why the focus, Sumit was saying, not just on making delivery business profitable, but on utilities, on rents, on all these items, so that the dine-in business also continues to turn positive, right, or become more and more positive. So I think I have a strong view now. I actually feel good seeing the last year and the year before that as well. If I take the 2 years together, I think I can frankly say that we have seen double-digit improvement in traffic in our restaurants, this dine-in business. And so I feel very positive of dine-in business growth in the future.
Got it. Second question, you spoke very enthusiastically about the digital transformation or digital initiatives that we're taking. Now, what is the goal seek here? Like, as an external or as an outsider person, how should I judge ROI on this? Will it reflect in better SSG? Net promoter score is very abstract, so perhaps won't reflect in financials directly. How do you internally assess that wherever you would have done this digital transformation totally in your stores? What is the objective parameters that you are tracking to say that this is working?
All right. First of all, I speak enthusiastically about everything in my business. So
yeah, sure.
So okay. Look here. There is a concept called know 100% of your customers, right? Whether a company reaches there or strives to reach there, the goal of every company is to know 100% of their customers. When they come into your POS and they pay money or whatever, you do not know these customers. You do not know whether they are vegetarian or non-vegetarian. You do not know whether they come in for a snack or for a meal. You do not know whether they live in a certain part and buy in 2 different restaurants of yours. There's a lot you do not know about the customer, which means that you do not market to them. You do mass marketing and you hope some of these people catch your marketing. As you learn your customers over time period, you're able to specifically market very specific propositions to these customers. So that is a very, very big requirement for most companies, and most companies want to learn about their customers, want to learn how they eat and what they like, where they want improvement, so forth. So that is one big one, right? And that helps sales, it helps CRM, it helps loyalty of those customers as well, because now you're basically able to talk to them. Second, with SOKs, you have adequate. So for example, now where we had 3 tills, we have put 4 self-ordering kiosks or 5. Sometimes Cicely even put 6 of them, right? So there's ample amount of SOKs over there where people can spend time and place order at their ease. And what we are seeing is a higher check that you see on orders that are placed on self-ordering kiosks versus those that are placed on POS, where 3 or 4 people might be in a line and the one in front wants to quickly place his order and move so the next person can come in. So a lot of benefit from that. The next one, most 90%, as I said, of these sales are all digital, which means the payment is gone to the bank directly, right? As these payments go directly, there is a significant advantage of money handling, significant advantages of processes and systems in place, right? So all those advantages also, so there are multiple benefits that you get with SOKs. It's a proven concept around the world. It is not something that RBA is doing unilaterally. There's learnings by different brands, by multiple brands, that this is the way it's moving forward. And interaction with the SOK actually gives a better sense of timing for this customer. Someone who's waiting behind in the line, not interacting, feels a longer sense of time than when they're interacting with the SOK. It actually makes them feel they spend less time placing the order and less time getting the order. So a lot of benefits in addition to fully understanding the customer. There are direct benefits of increase in APC. There are direct benefits of being able to show them all different options. For example, if someone is a vegetarian, they can directly go into the vegetarian menu and then explore all of it, right? So this is something just like cell phones, right? We are now a very digitally savvy country. In fact, I think we are one of the best equipped digitally savvy countries. I am actually talking to the president of Burger King of RBI for the APAC region, and he said we are one of the highest digitally, just in the 18 months, highest percentage of digital orders placed by Burger King anywhere in Southeast Asia. It's unbelievable that India just started this 18 months ago and is on top or among the top 2 digitally, where the orders are placed digitally. So all these things are help, and that's the ROI on this.
Sure. So what broadly I was trying to understand that, is this just a vanity metric? Just a one point, just last point. Is this just a vanity metric, or you should, as an outsider, I expect that this will convert into stronger SSG to evaluate whether it is successful or not? That's the only point I had.
Yeah, no, this, like I said, knowing your customer, ability to market them instead of doing mass spending all over. If you have the ability to directly speak with your customer, it's efficient, it's cost effective, right? It costs you, if someone downloads your app, for example, you are able to communicate with this person at no cost. Whereas if you're sending someone an SMS or a WhatsApp, it costs you money, right? So digitally, one, it is more effective. Second, it is costing less, right? It costs you less as you progress in years to come, that it costs you less to reach out to your customers. And it increases frequency of use of brand. When it increases the frequency of use of brand, it helps SSSG, right? What is sales? Sales is equal to traffic into APC, or average per check. If traffic is equal to simple, new people coming in and old people coming in more often. So it actually helps this piece of old people coming in more often, or existing customers visiting your brand more often, frequency. So yes, it helps in SSSG, it helps in SSTG, right? It helps in APC, and it helps in total ADS.
Got it. Thanks and all the best.
Yep. Thanks.
The next question is from the line of Amnish Agarwal from PL Capital.
We will take this as the last question because we have crossed the 6:30 mark. Sorry, go ahead.
Yeah. So, hi Rajiv, I have two questions. My first question is that this time around we have not given any target of store openings next year. Now we have an agreement with Burger King International which gives us a roadmap till FY27.
Right.
So is it indicating that we might look at, say, some sort of a slowdown in the store openings in the coming year? That is one. And my second question is that you talked a lot about the cost cutting on the SG&A side in India, whereas if I look at the last 3 years, our SG&A has actually gone up from nearly 60 crores on an annual basis to now a run rate of around 27-28 crores. So why has the increase been so sharp, and which all heads are now you going to attack to bring it down?
Yeah, please don't use that word, heads. I'm not attacking anyone's head. Look, two things, right? Number one, you asked the question about
growth.
Growth. So we are not slowing down, guys. Please, we are not slowing